This podcast is intended for investment professionals only. All investing involves risk.
Hello and welcome to Market Talk, where today we'll be discussing the big moves in Chinese equities, what the latest job numbers out of the US tell us about the path of rates, and where next for the Japanese yen as the country prepares to welcome a new Prime Minister. I'm Harry Brooks, and today I'm joined by Ben Bennett, Head of Investment Strategy for Asia, who joins us from Hong Kong. Welcome back, Ben.
Thanks, Harry. Yeah, we've been on a holiday in mainland China most of last week. Actually, we get another holiday at the end of this week, so it's in the middle of holiday season here in Hong Kong, at least.
Excellent. Well, let's start by talking about the China rally. Since you and I last spoke about 4 weeks ago, the Hang Seng has risen almost 30%. Chinese stocks have notched up their biggest single-day gains in 16 years, I believe. What prompted that rally, Ben?
Yeah, I mean, it's been a huge rally. Actually, today we're speaking on Tuesday, aren't we? So it's given back a bit of that rally in the Hang Seng. It's down almost 10% today. But if we would have been speaking yesterday, and to be fair, even up until today, it still had a tremendous rally, up sort of 25, 30%, depending on which day you start. So what we had was a few policy announcements by Chinese policymakers before the start of the China Golden Week. So it's a couple of weeks ago now. So a couple of things. After the Federal Reserve cut interest rates, I think that probably was a trigger that allowed a lot of central banks globally, but including the PBOC, the central bank in China, to loosen monetary policy. And that's because, with US rates in yields falling, that makes the dollar a little bit less attractive to go and buy. So other countries can also lower their interest rates without fear of losing control of their currencies and people flying out and buying dollars. So that eased the pressure. So a lot of other central banks have also cut interest rates, but China's extremely important, of course. They cut rates. They announced some more extension of loan forbearance. So this is allowing the banks to say that loans that aren't very good on the balance sheet are still okay for now. They could just sort of give it a couple more years to see if things get a bit better. Bank capital injections, again, just sort of helping the banks there. Credit for the property sector and also for buying stocks, for buying equities, actually being able to borrow money from banks to buy equities. So that was all monetary policy, which to start off with, it was a bit of that's interesting. But all those things have been done in the past to some degree, maybe not all, but most of them have been done to some degree in the past. And then a couple of days later, we had a Politburo meeting, which is chaired by President Xi. It's a very important meeting. Normally happens every month, but this was peculiar because it happened straight after this monetary policy announcement. And also it was about the economy, which normally doesn't happen this time of year. And there was all sorts of very positive rhetoric about stabilizing the economy, stabilizing the property market, which hadn't really been said before. Property market has been under a lot of pressure for a while, but policymakers have allowed that to some degree because that's what they want to happen. They want to shift money out of the property sector into other parts of the economy. And then there were lots of sort of unconfirmed reports in things like Bloomberg and Reuters about sizes of policy support that might come out. 2 trillion renminbi was spoken about as a potential for bond issuance that could then be injected into the property developers or into local government to stem some of those issues in the local government sector. That's about 1.5% of GDP. There was even sort of spurious accounts of maybe up to 10 trillion renminbi, which would be huge. That would be 7.5% of GDP. So all this has gathered momentum and did lead to this big market correction.
The timing was interesting, wasn't it? With you mentioned the holidays in China, Golden Week holiday, I think. That was just a few days after the announcement. Would that have had an impact, do you think, on the size of the moves that we saw in the market?
I think it has. I mean, there are a few reasons. I mean, the moves that we've seen are huge and, unprecedented. We've sort of used that word a lot since COVID, haven't we? But these are actually unprecedented rallies that we've seen in some of the local equity markets. I do think that the squeeze up to the big holiday, mainland China was on holiday for a whole week. In Hong Kong, we had 1 day holiday. But still, up until that holiday, I think investors perceived that we haven't got very long to get our money into the market. So there was a bit of a rush. We sometimes talk about the rush out of deposits from banks when they go horribly wrong, and there can be a squeeze out of the exit door. This was a squeeze into the entrance door. I mean, it can happen both ways. I think that did impact the market moves, but also there was tremendously weak sentiment about Chinese equity markets. This has been going on for years. Very light positioning from some of the global funds that have been reducing their position. So it started from a low base of positioning, and everyone was trying to get it in. So there weren't very many people left to sell as well. So you add all that up and you get these massive moves. So we were talking about that sort of 20-30% moves. I had a quick look on my Reuters, and since the end of August to Monday's close, so this is yesterday's close, we're talking on Tuesday, the Hang Seng was up 28%. The Hang Seng Tech Index, which is the sector-based Hang Seng Index, Hang Seng, part of the Hang Seng, which is very high beta, very volatile. That was up 51% over that period. So up nearly over 50%. The CSI 300, so that's the mainland index, up about 20%. But remember, that had been closed for a week whilst the Hang Seng was still rallying over that period, because that's a mainland index that was closed for Golden Week.
Okay, interesting on the positioning. We'll come back to that question in a moment. But taking a step back just for a moment from the price moves that we've seen over the past few weeks, if you had to sum up the real underlying issues for China's economy today, what would you highlight? You mentioned the CSI 300 a moment ago. I had a look at the same chart, and if you look at that over the past few years, it's been on a pretty consistently downward trajectory for several years now. Do the stimulus measures that have been announced really have what it takes to turn it around?
I don't think so. I think that we're still in a phase where there's a very big balance sheet issue for China, which a lot of this has been the balance sheet issues have been built up for years, because we all know, and China policymakers are freely admitting this, that there's been too much investment in, I guess, areas of the China economy which have been not particularly efficient. So people buying and building too many houses, too much infrastructure investment in things that haven't been delivering the same sort of economic output that the policymakers were hoping for. So that's been built up for years and years and years. And then policymakers have decided that they want to shift from that inefficient investment into more efficient things, technology manufacturing, the sort of the energy transition, all the things that we know that are being built in China. The problem is that the legacy of those bad investments, I mean, you've got a huge amount of debt, and you've got that debt across banks, across the consumers, across local governments, and it does weigh on the economy. Now, Chinese policymakers can choose to go back to what they were doing before and pump more debt into the economy, encourage more investment into houses, into infrastructure. They could do that, and maybe that's what they're going to do. I just think that would be such a big turnaround for government policymakers that have these long-term visions that want to change the long-term roots of the economy. I think that just was too much. I suspect that they're not doing that. So I don't think it's going to be enough to be able to fully turn around that. And look, we've seen in the past huge amounts of stimulus from China. Back in 2008, for example, post the global financial crisis, sort of over 12% of GDP was pumped into the economy. And that was almost the start of what we've seen, that sort of the debt growth that we are now trying to deal with was almost the start was back then in 2008. The first few years were totally fine. There was very efficient investment. It's just the last few years which has been inefficient. But remember, that's over 12% of stimulus. We're talking here about stimulus of maybe 1.5% of GDP, maybe 3% of GDP if it really became a few trillion renminbi. But it's not that type of investment. So I don't think it's a huge amount. And in any case, I'm not entirely convinced that policymakers want to turn around from what they've been trying to do and re-aim the economy into something more efficient.
That's a really useful long-term perspective, in the context of these comparatively short-term moves we've seen. Another angle that I wanted to touch on is the question of valuations, which I think came up last time you and I talked as well. Are Chinese equities perceived as cheap, and are they still seen as cheap following the big rally?
Yeah, this is a really hard question, isn't it? Because it depends on what you're comparing it to. It's like, this is, of course, look, I mean, the Hang Seng, which is the Hong Kong stock market, which has rallied the most because it's been open over the last week or so. If you look at one way of looking at valuations, which is the PE ratio, so the price of equities divided by earnings, so future earnings, that's the sort of the multiple of future earnings that you're paying for the equity. That ratio is back to where it has been on average over the last decade or so. So it's not as if prices were, I guess, cheap before. It's easy to say now, before the recent rally. So the PE ratio was low, so you weren't having to pay an awful lot of multiples for your earnings. Now it's average, so it's hard to say now that it's cheap after the rally. But then you can compare it to other equity markets. The S&P 500, the PE ratio is very, very high. The cost of trying to buy those S&P earnings is very high. Everyone wants to buy US equities, so they're extremely expensive. But you could also argue that if you buy US equities, you're buying companies that, the 100% focus of management of these companies is to make earnings. So, of course, you've got to pay a little bit more for those earnings because you're going to be rewarded by management. In China, I would argue, I think everyone would say the same thing, that company management is not necessarily 100% focused in maximizing profit. There's a social aspect to it. There's these long-term things that we're speaking about. So maybe they shouldn't be quite as expensive as US equities. Anyway, it's a long way of saying that I don't think Chinese equities are particularly cheap. They are maybe a little bit cheap still, but they're not particularly cheap, even after these, the 20 years, 10 years of relative underperformance versus the S&P 500.
So you mentioned that overnight, we're recording this on the Tuesday, we saw a correction, which followed a disappointing press conference from the Economic Planning Committee. I saw a fun quote in the FT today from an economist who said, "This is what happens when you feed the monster. Every day you need to increase the amount of food or it turns against you." What's your take on the correction, what led to it, and where we might go from here?
Yeah, I mean, so he's talking about the monster in terms of like people speculating on hoping that equity prices go up and stuff. I mean, the problem is, like I said, it was this trifecta of weak sentiment, low positioning, and a squeeze into the holiday season. So that led, I guess, to markets investors getting a little bit too enthusiastic. I mean, the monster was growing too big, I guess. And yeah, today we had a press conference by the NDRC, which is, as you said, the Economic Planning Committee, where they didn't come out with any particularly specific numbers. I've been talking about these numbers, percentage of GDP, trillions of renminbi that needs to be injected or could be injected into the economy. They just repeated the rough outlines, relatively ambiguous support, still saying they will support, but there's no numbers. So that was the disappointment. And if you see the market shoot up, then if there's a disappointment, then it can fall down a lot. We saw the Hang Seng fall 10% today. Maybe tomorrow it'll be up 5%. Maybe it'll be down 5%. I think what we're in at the minute is quite a volatile period as we're settling down.
Okay, well, we're going to catch up again in a fortnight's time, so no doubt we'll have a chance to talk.
Probably totally wrong by then, but we'll see.
We'll find out. So turning next to the US, September's payroll numbers came on Friday, and they were well above expectations, which suggested that employers aren't hitting the pause button on hiring ahead of the election with the uncertainty that brings. And core inflation in the US, meanwhile, has been steadily falling for the past year, I think. It feels like the US is in a bit of a Goldilocks moment at the moment. How do you feel about the outlook?
I think that's right. I think let's remember a few weeks ago we had a couple of equity wobbles in the US, didn't we? again, nothing like the volatility we've seen in China, but we had a little bit of disappointment at the beginning of September following some earnings results that are a bit weaker. We did have a slightly weak payroll print, started making investors worry slightly that we could be in a recession. The Federal Reserve, or not a recession, but a slowdown, let's say. The Federal Reserve cut by 50 basis points in the last meeting. And within, markets, there was still a fairly high chance that they might do another 50 basis point cut at their next meeting, and then maybe another 25 by the end of the year. So investors were getting a bit worried about growth, wobbly equities, pricing in a fair amount of rate cuts. And then, as you say, last week we got a very strong unemployment report. Not only a strong one for the last month, which was up about 250,000 jobs. We also saw the unemployment rate dip down to nearly 4%. So that's come down again. It had crept up, triggering this mythical Psalm rule that you've probably heard about that would again making people worry about a downturn. But that's totally reversed. That's pretty much totally reversed. And also they revised higher some of those weaker employment reports in the last couple of months. So everything is looking pretty good. And the Atlanta Fed GDP tracker for Q3 is at 2.5% for the annualized growth, which is, again, totally fine. Goldilocks, yeah, because also we're seeing inflation come down. We've got on Thursday the CPI print for the US. Core CPI is at 3.2%. That's come all the way down from the lofty numbers that we were panicking about a couple of years ago. It'll probably be around 3 and a bit percent again this print. So we've got this perfect scenario of growth being fine. We've got CPI, inflation falling as well. What's happened on the back of that is equities generally have been positive because you've got that growth angle. Yields have started to go up again, though, because at the short end, I mentioned before that there was a chance that we could have seen another 50 basis point cut by the Fed, but now that's there's little chance, less chance of that, I guess is the best way of putting it. It's now much more likely we just get a 25 basis point cut. So we saw 2-year yields go up, but that's been as a positive for the economy type of move. A couple of years ago, we were worried when yields went up because that was squeezing the economy. Now yields go up, that means that the economy is doing fine. So equities have been rallying, yields going up a little bit. 10-year yields, 2-year yields, back at about 4%. But again, that's totally fine. Goldilocks is probably the best way of describing it. A soft landing, I'd say, is the economics way of saying it.
I'm interested in the comparison with what's happening in Europe, where the ECB cut rates by 0.25%, 25 basis points last month. And I think they cited in that decision subdued economic activity. How does the growth and inflation picture in Europe differ from the US? And what are markets expecting from the ECB in terms of cuts for the rest of this year?
It is funny because the narrative between US and Europe is quite different. So the US, I've just spoken about pretty strong growth, falling inflation. In Europe, it's a little bit more, growth is worryingly low, particularly in Germany, which has been associated with the slowdown in China, for example. So Germany's been weak. Inflation is also falling. But actually, when you look at what's priced in for both central banks, it's exactly the same. So in the US, we've got 25 basis point cuts by the Fed priced in, 2 more by the end of this year, exactly the same for the ECB, 2 more 25 basis point cuts from the ECB going into the end of the year. So it does look as though they're both trying to trim rates. But this is in Europe, it's coming from a lower level. I guess that's the best way of putting it. So yields are already lower in Europe and they're going to be trimmed more. So I guess that's what we're talking about in terms of growth being a little bit weaker in Europe. 10-year Treasury yields at about 4%. 10-year German bunds are just over 2%. So you're sort of coming down from different levels. Again, that's you're just a little bit more worried about Europe. And looking ahead to 2025, because it's about that time of the year, isn't it, when we start doing our outlooks for 2025. Interestingly, both the US and Europe growth for 2025 are expected to be roughly the same. So the US is expected to slow from the sort of 2.5% GDP down to a little bit above 1.5%. And Europe is expected to do a little bit better and get up towards 1.5%. So coming from different angles, but hopefully with the support of central banks, they might sort of meet in the middle next year, which then, I guess, poses a question, and we'll dig into this, I'm sure, in the next few episodes.
So the last stop on this week's Round the World Economic Update is Japan, where a new prime minister has been rubber stamped by Parliament. Having covered that surprise rate hike from the Bank of Japan in our previous podcast, I'm interested in how markets have reacted to the appointment. Is it too soon to know what the incoming PM might mean for the path of the yen?
From the currency perspective, the thing that investors were really interested about was whether or not the new Prime Minister, Shiba, whether or not he is going to be fiscally, or from a monetary basis and a fiscal basis, is he going to be hawkish? Is he going to be dovish? And in Japan, a lot of central banks are independent across the globe. So Bank of England is independent from the UK Treasury. Same with the Federal Reserve. In Japan, they're much more linked. There is a link. There are agreements, and it all stems from Abenomics, like 10 plus years ago, when they decided to pump prime the economy. So it does really matter what the Prime Minister in Japan thinks about monetary policy. And there was an initial reaction that potentially Ishiba, from things that he said in the past, is a little bit hawkish. So would look to hike interest rates. And as you said, we spoke at length last time about the repercussions of a rate hike by the Bank of Japan and leading to that flash crash in Japanese stocks. And there was a little bit of a wobble there to start off with. But then he came out, he met the Bank of Japan governor, Ueda, and said, look, Japan isn't in a situation where it can be hiking interest rates aggressively. He says so he sort of tempered the market concern, investors' concern about that. So talking a little bit less, I guess, more dovishly, which led to the yen weakening a little bit, because if you're not hiking interest rates, it'll weaken. It's pretty much in the middle of the range that we've seen this year. The yen to the dollar got down when the yen was as strong as it was a few weeks ago, down to about 140, and it got to about as weak as 160. It's about 148 now, so it's somewhere in the middle of that. So as we were. And like I said, I don't think any policymaker in Japan is going to want a repeat of what we saw a few weeks ago with that flash crash. I think they'll just be quite cautious about giving signals and cautious about hiking interest rates too much.
It's reached that point in today's recording where I asked that familiar question. What's your number of the week, Ben? So
I thought I'm going to bring it into sort of a discussion about sort of emerging markets here. So my number's 19 days. And you probably wouldn't guess the topic of this, but it's going to be Bank Indonesia, so Indonesian Central Bank. So 19 days is the number of days between when Bank Indonesia cut interest rates 19 days ago, or 19 days before. They just recently intervened in the FX market. So why is that interesting? So when they cut interest rates by 25 basis points on the 18th of September, that was based on the fact the Federal Reserve was cutting interest rates. So Federal Reserve cut interest rates. I mentioned before, central banks across the globe breathed a sigh of relief. Bank Indonesia is one of those, cut interest rates. Thank goodness for that. Don't have to worry about money leaving Indonesia and the currency depreciating and taking on inflation. And people who look at emerging markets like myself are cheering and going, this is just great for emerging markets. But what's happened since, and it's just been 19 days, is we've seen this better data out of the US. And that better data out of the US means that we've seen higher interest rates in the US, these 2-year yields flying up, less chance of rate cuts in the US. And that straight away puts pressure back on these central banks. For example, in Indonesia, the currency we started to see properly depreciate. So money was leaving Indonesia, going into the US, presumably because of those higher yields. And then it was just, like I said, 19 days since they cut interest rates before they had to step in and try and intervene and stop their currency weakening, which in hindsight, they probably shouldn't have cut interest rates, should they? So things can turn so quickly, just 19 days between these two things. And look, I do think that over the next year or so, the Federal Reserve will still be able to cut interest rates. And ultimately, that will be positive for emerging markets because that will allow them to cut interest rates, places like Indonesia. But it is worth just bearing in mind that all these central banks, all these countries are fixated on what happens in the US, what happens with their monetary policy. I've mentioned already Donald Trump and obviously the election, whoever wins that and what it means for monetary policy in the US, fiscal policy in the US. That's going to be important, not just for the US, but globally as well.
Super interesting, Ben. Thanks as always for your perspective and lots to talk about in the next episode, no doubt. And thanks to all our listeners at home too.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. The views expressed in this podcast are those of Legal & General Investment Management Limited, as at the date of publication. This podcast is for information purposes only, and we are not soliciting any action based on it. The information discusses general economic, market or political issues and/or industry or sector trends. It does not constitute research or investment, legal or tax advice. It is not an offer or recommendation or advertisement to buy or sell securities or pursue a particular investment strategy. Assumptions, opinions, and estimates are provided for illustrative purposes only. There is no guarantee that any forecast made will come to pass. No party shall have any right of action against Legal & General in relation to the accuracy or completeness of the information contained in this podcast. Where this document contains third-party information, the accuracy and completeness of such information cannot be guaranteed, and we accept no responsibility or liability in respect of such information, not for distribution to any person resident in any jurisdiction where such distribution would be contrary to local law or regulation. Copyright 2024. Legal & General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. In Hong Kong, this material is issued by Legal & General Investment Management Asia Limited, regulated by the Hong Kong Securities and Futures Commission. For full terms and conditions, please visit our website. To find more content, you can check us out on X, formerly known as Twitter, LinkedIn, and our website.